Yes guys, let's discuss the next standard, AS 9. Revenue recognition. Before even we touch the standard, let's get the basic of the standard first. Remember, we learn a concept called as materiality. Yes, similar way we have also had a concept of matching. Now what was the matching concept talking about? Matching concept says, my expenses should be matched to my revenues. It is not the other way around. It is not revenues being matched to expenses. It is expenses matched to revenues. So that means he's saying my expenses should be recorded according to what the revenues are being recorded. So according to your matching concept, I cannot determine what is a revenue, but I can only determine what is an expense. Then how do I determine revenue? Revenue is determined as per your revenue recognition concept. Revenue has a single source of recognition, that is with respect to AS9, and this AS9 standard excludes AS7 because AS7 is also a revenue recognition standard, but that is with respect to only construction contracts. Specific standard there, this is a more general standard, applies to any revenue recognition process. So this is a background of the standard. Let's touch the applicability now. Applicable to all enterprises. One, 2 and 3 without any relaxations to any other SMEs. So the standard is applicable in full to every enterprise. Go with the name, it is recognition of revenue. No, we are not talking about accounting. We are neither talking about disclosure. We are only talking about how do I recognize revenue. That's it. Now, for recognition of revenue, we'll split the standard into 3 parts. The first part we discuss with respect to sale of goods. The second part of the standard will talk about provision of services. And the last part of standard we discuss about use of enterprise resources by others. These are the 3 broad parts of the standard for us to understand what is the revenue recognition. So we are discussing the revenue recognition rules for sale of goods, for provision of services, for use of enterprise resources by others. Probably these 2 headings are self-explanatory, sale of goods and provision of services, but what is this concept of use of enterprise resources by others? My resource being used by someone else, he is remunerating me in certain form. So it is a revenue for me for allowing him to use my resource. If you remember, AS19 talks about leases. Lease is also the same concept. It is my resource. It is my asset. I have given a right to someone else to use that asset. And I am recording the revenue whatever he pays. He pays to me lease rentals. How I record those lease rentals is a revenue recognition concept. But such revenue recognition, anyways, we are dealing with AS19, which is a specific standard. We are talking about more general standard. So I won't talk about leases now. But there's a lease of intangibles. That means I have a patent or I have a copyright. Now such patent or copyright which is held by me or which is registered under my name is being used by someone else. Let's say I am an author of a particular book. The publisher has taken the right to publish the book. Now it is authored by me or it is written by me, published by someone else. Now the publisher will be earning revenue by sale of that book. Then what will I earn? I will earn something called as royalty. Such royalty what I earn is an use of enterprise resource by someone else. It is my enterprise resource. That patent or that copyright is on my name. Who is using it? Someone else is using it. So, use of enterprise resource by others. Similarly, let's say I have a route permit. Let's say I have a route permit to ply a vehicle from Jammu and Kashmir to Kanyakumari. I have taken this route permit. Now, route permit is a piece of paper. Such route permit, I did not have a vehicle to run. So, I have leased it out to someone else. I said, this is my right. I am endorsing my right in your favor. You can use this right. Now, someone who is using the right, he is using his transport, he will be earning revenue. Then what am I earning? He will remunerate me in the form of royalty again. So, it is my intangible asset which is being used by someone else. So, whenever you have such situations, we talk about use of enterprise resource by others. Simplest form of use of enterprise resource by others is cash. My cash used by someone else. How can someone else use it? I give him in the form of a loan. I have cash, I am giving a loan to someone else. So my cash is being used by someone else. Or I have subscribed the shares of some other company. Now that shares of some other company, I am giving cash to him. Now he is using it. So in either of the cases, if I am giving in the form of a debt, I will get interest. If I am giving in the form of equity, I will get dividend. So even that is also use of enterprise resource by others. So that is the enterprise resource being used is called as cash here. So it could be either intangible asset or it could be cash. So whatever I earn, in this case, use of enterprise resource by others will be restricted to royalty income for lease of intangible assets, or it could be interest income if I have given cash in the form of a debt, or it could be dividend income if I have given cash in the form of equity. These are the three parts to be understood. Use of enterprise resource by others. My resource being used by someone else, I am being remunerated. The consideration received is of three parts: royalty, interest or dividend. Royalty income. Let's take the book case. I am an author of the book. I have given a right to the publisher to print the book and to sell it in the market. Who is getting the money? Publisher will receive the money and the publisher will pay me in the form of royalty. Such royalty can be fixed in two ways. Per book basis. Per book, 40% of the revenue is yours. Or I will say that out of the total revenue, I will give you 10 rupees or 10% of a rupee. So it is something like this, or I can also say fixed sum. Per year, I will give you 25 lakhs of royalty. End of the story. Now I can sell how many books I want. What I'll pay you is a fixed amount of 25 lakhs. So royalty, there is no particular way of deciding how much is a royalty income. So always revenue recognition of royalty should be based on royalty agreement. The manner in which the royalty agreement is drafted will determine how do you recognize revenue in case of royalty income. If it is determined on per book basis, then we have to identify what are the number of books sold and we have to recognize revenue accordingly. If it is on a fixed basis, then whatever the fixed amount is. When we're talking about interest income, irrespective of the amount is paid or not, interest income should always be recognized on time basis. Time basis is nothing but accrual concept. We popularly know it as accrual, but AS9 uses the word time basis. That means if a financial year covers 12 months, then 12 months of interest should be recorded as revenue. Dividend income. Dividend income is not time basis because there is no time for a dividend. So whenever we talk about dividend, it says that income should be recognized when right to receive dividend is established. When right to receive dividend is established. How? We are using the word right to receive. Now when do you say that they have a right to receive a dividend? Now normally, if you are talking about the timeline of events for a dividend recognition, we normally have events like the first thing, balance sheet date. Once the balance sheet date is completed, they normally draft the annual reports, and such annual accounts, whatever are there, should be adopted by the board of directors in a board of directors meeting. So in the board of directors meeting, they will adopt the financial statements, and they will also give a notice for the general meeting proposing a ratio of dividend. So let's say 20%, 25%, whatever it is. They'll announce a percentage of dividend and they'll call for a AGM. So notice is also drafted there. Now once a notice is given for, then they will be calling for an AGM on a particular date. Now, and on the date of AGM, sometimes there could be a resolution passed as it is, or there could be a situation where there is an enhancement of dividend, or there could be a situation where there is a reduction of dividend as well. Now, enhancement of dividend is a problem. If you want to reduce the dividend, no problem, same AGM you can continue solving. But if you want to increase the rate of dividend, then it is not possible in the same AGM. So what happens? The AGM gets adjourned and you have to conduct the AGM with a fresh notice being issued within 1 week on the same day in the same place. Now again, then the enhanced rate of dividend will be passed as a resolution. And then from the date of the valid resolution is passed, 30 days you have to pay the amount of dividend. Oh my God, so many events. So many events starting from balance sheet date, went about board of directors meeting where they have adopted the financial statements, then they called up an AGM, notice is being issued, then they conducted the general meeting, then they have passed a resolution in the general meeting, and then they have paid the dividend after 30 days. Now which day from these events? Starting from, if you talk about 31st March is the balance sheet date, my last date when he pays dividend, it should be sometime in the month of October. Now when we're talking about October or November, there's about 6 to 7 months in between, and what is the date when he has got a right to receive the dividend? Now, is it the balance sheet date? Is it the date on which the AGM is called for? Or is it the date on which the dividend is proposed? Is it the date on which AGM is conducted? Is it the date on which the resolution is passed? Or is the date on which the dividend is received? Now what is the date when I say that the right to receive dividend is established? Balance sheet date? Not possible. Dividend is proposed. Where is dividend proposed? Dividend is proposed by the board of directors in the board of directors meeting. Not possible. Resolution passed in general meeting. This is the date. This is the date when I say the right to receive dividend is established. Right to receive the dividend is established when a valid resolution is passed in the general meeting. There is a small exception rule here. Exception rule to this will come in the case of holding and subsidiary companies. Because by the logic goes, normally we say that if someone holds more than 50% of the voting power in another company, they normally can influence the decisions of the other company. And that is what we call it as controlling interest. A holding company has a controlling interest over the subsidiary. Now, if the subsidiary is proposing a dividend, I would say it is bound to pass. Because in proposing the dividend, there is a share or there is a particular say of the holding company in it. Unless and until the holding company agrees to a particular percentage of dividend, they will not be definitely proposing the dividend, because the holding company can also constitute the board of directors. So that means they can change the constitution of the board of directors. Definitely the idea or the particular decision of proposed dividend is influenced by the holding company. Now there is no uncertainty for the dividend to be passed. There is no uncertainty. It is certain to be passed. Even if the remaining shareholders, the minority shareholders are shouting for it, saying that, we don't want this percentage of dividend, that the resolution can still be passed because the holding company holds majority share. when they hold majority share, the resolution is bound to pass. So for a holding company, only for a holding company, I am indicating by word H, holding company can recognize dividend income from a subsidiary indicated by this word S. Holding company can recognize dividend income from a subsidiary when the dividend is proposed. We use this concept in solving problems of consolidation, that is financial statement of group companies. We use this particular concept, very unique concept. Holding company can recognize the dividend income for a subsidiary when the dividend is proposed itself, because the right to receive dividend is established on that date itself, because it is bound to pass in the general meeting since the holding company already controls the subsidiary. Now this is for use of enterprise resources by others. So we discussed about royalty income, we also discussed about the interest income and how the dividend income is being recorded. So my revenue recognition for three concepts is discussed under use of enterprise resources by others. Now let's move into the concepts of provision of services. This is probably one of the very important parts, because in your valuation of inventory, that is AS2, valuation of work in progress for services is excluded. You cannot calculate the work in progress for a services as per AS2. Now when there is an exclusion as per AS2, then some other standard should explain what is a work in progress now. So that work in progress for services is discussed in this particular standard of AS9. Though it might sound very unique, because a standard is talking about revenue recognition, how is it discussing about work in progress of services? It has to discuss at a particular point. Let's see what is that point. When we're talking about provision for services, I will divide the services into two types. One type of service is called as divisible service. Other one is called as indivisible services. Now what is this divisible services, indivisible services? Divisible means a service can be broken into small parts. Indivisible, I can't break it into parts. I may not be able to give you a perfect example for a divisible service, but I can give you hundreds of examples for indivisible services. The easiest way to understand this is probably, let's understand the case of a doctor. Doctor has started an operation on 31st March. It's a 6 hours operation. He started the operation exactly by probably around 8 o'clock. 4 hours of operation over 31st December, exactly 31st March, 12 o'clock. Now the accountant asks how much of the operation is complete. I've already opened the heart, it just, packing up is possible. Now can I say that, okay, out of 6 hours of operation, 4 hours operation complete, so 2/3 of the work is complete? Not possible. Can you divide? I can't divide. Let's say a person has started painting. Okay, so this person started from the foot. He started painting a particular, let's say my portrait only I wanted to make. So I started painting and he came up to the head and he said, sir, you are 6 foot, sir. So head probably about 1.5 foot. So leaving that 1.5 foot, remaining work is complete. So my revenue recognition should be, so for the remaining 4.5 foot out of total 6 foot, I said 3/4 of the work is complete. Possible. Now the head can be for anyone. Now I cannot say that the revenue can be recognized that way. You can take any person. Any person you bring up, whenever he is trying to use his professional service. Let's take a chartered accountant. Chartered accountant, let's say I am put up for an audit. In the audit, let's say I have started auditing and I said the audit is for 60-day period. By 31st March, I have completed the audit for about 30 days. And I said 50% of the work is complete. But ultimately, the fees which I am getting is for expressing an opinion on the financial statement. Now that expression of opinion on the financial statement actually happens towards the end of the 60th day. Can I say that the audit is 60 days and 30 days half of the work is complete? Not possible. I can't leave the work and say give me half remuneration. No one is ready to give because the work is not at all completed. Now this is the basic problem. Whenever you talk about any professional service, break any professional service, you cannot break the service into parts. Those services are called as indivisible services. You can name any person, guys. Professional services can be chartered accountants, architects, doctor, all these people, lawyer, all these people are professional services. You can't break them into parts. They are called as indivisible services. But what are the divisible services? I would say other than divisible service, indivisible services. So anything which cannot be indivisible service is a divisible service. So basically what we are trying to put across is, I can break it up into parts. Let's say I have given a contract for a person to provide a watchman to my enterprise for 12 months period. By 31st March, he has already provided the watchman for 9 months. Now can he say that I have completed 9 by 12th of the work? Yes, he did complete 9 by 12th of the work. So it's only 3 months of the service which is remaining. I can divide it into parts because there is no use of professional work there. Now watchman does not require any great professional skills to perform the duty. So basically whenever you're talking about such services, I would put them under divisible services. Divisible services in the sense, basically that service can be divided into parts. Now, you'll ask me, we are talking about revenue recognition, then why did we discuss about divisible and indivisible services? The logic is, revenue recognition for divisible services and indivisible services are completely different. Whenever we are talking about divisible service, my revenue recognition concept for a divisible service is based on proportionate completion. So this is called as proportionate completion method. In the sense, if 50% of service is already complete, then 50% of revenue can be recorded. Let's say the contract was given for about 8 lakhs. Out of 8 lakhs, let's say he said 60% of the contract is complete on the balance sheet date. So 60% of 8 lakhs, that is 4,80,000 of revenue can be recognized if it is a divisible service by using this method called as proportionate completion method. Now, how do I identify this proportionate completion? To identify proportionate completion, you can do it either by physical observation or by technical evaluation. Either of the methods can be observed to identify what is the proportionate completion of a particular project. So this is for divisible services. So we use proportionate completion method for divisible services. Can I identify the same proportionate completion for indivisible? Something which cannot be broken up into parts, how will you identify proportion? I can't identify proportion of a work. So I can't use the same method here. I can't divide it into parts. So here I will use a method called as complete service method. That means revenue should be recognized only when the service is completely provided. Unless and until the service is completely provided, I will not recognize revenue. This might sound easy because here you have to identify what is the percentage of completion which is done. Here I don't have to. I'll simply say that if the service is complete, recognize revenue. If the service is not complete, don't recognize revenue. But the problem arises when you're talking about complete service method. Let's say I have started a service and my balance sheet date is 31st March. I have started my service on 20th of February. I've completed 40 days of service up to 31st of March. During this 40 days, I have incurred expenses because in providing services, definitely I'll be incurring some expenses. Let's say I was paying staff to the salaries who are performing the service. I've been using some equipment. I've been incurring some power or electricity charges and providing such service. Traveling expenses, whatever it is, plenty of expenses have been incurred over the last 40 years in providing the service. So last 40 days in providing such service. But let's say on 31st March, I said the service is not yet complete. The service will be completed only in the month of April. Can I recognize revenue? I can't recognize revenue. But expenditure is incurred. Then we have to refer back to your matching concept. What is your matching concept saying? Match your expenses to revenues. So that means if you did not recognize revenue for that service, I cannot recognize an expenditure which is relating to that service. So, but I incurred the expense? Yes. But can I recognize that expense in P&L? No, because your revenue is not put up there. So what will happen? I'll have to, that revenue recognition is deferred. The expenditure also cannot be debited to P&L. Such expenses related to provision of service should also be postponed to the later period. Now how do I postpone? This is called as WIP. So expenses incurred in providing service up to the balance sheet date are transferred to WIP of services. So when I'm transferring it to work in progress of services, I'm not recognizing it as an expense in P&L, but I'm taking it as an asset in the balance sheet. So what happens? Next year when you recognize the revenue, this WIP, whatever you parked aside without transferring it to P&L, will be transferred to P&L later on in that next year. So again we are trying to match my expenses to the revenue. Got it? So by using this, I'm actually using my matching concept. I'm trying to match my expenses to the revenues. Since I am delaying the revenue recognition process, I am not recognizing the expenditure in the same financial year. I will recognize the expenditure in the subsequent financial year, though the expenditure is incurred in the previous financial year itself. Normally in a complete service method, let's say I've taken up a particular contract. I've started somewhere in the month of May and that service was almost for 12 months. It is an indivisible service. So for 12 months, in the sense at the end of 12th month I have to recognize the revenue. That means I will recognize the revenue only in the next year. By 31st March I did not complete the service because I started only in the month of May. So that means I have to perform the service up to 30th April next year. So when I'll recognize revenue in the next year only. So whatever expenditure is incurred from this May up to the end of March, that means probably for the 11 months period, that entire expenditure should be transferred to WIP. I can't recognize it as a revenue. Let's say I only have that service and nothing else in that. I am only providing that service. So basically there is no expenditure to be recorded in the current year. There is no revenue also to be recorded in the current year. The entire expenditure and revenue will be recorded in subsequent financial years. Such contracts we will not deal as per AS9, we will deal as per AS7. That is construction contract. The reason why construction contracts a separate standard was issued was because of that. Whenever you have services which are basically stretching over a period or an account more than an accounting period, then we'll have to use the concept of AS9. We can't recognize revenue as per your we have to use the concept of AS7. We can't use AS9 there. AS7 is a more specific standard than AS9, that is a general standard of revenue recognition. So 7 overrides 9. Got it? Now, we'll come to the last part, sale of goods. How do you recognize revenue for a sale of good? Now, when do you call it as a sale? Now normally when I'm trying to sell goods, there are plenty of types of services which happen. One type of service is I go to the customer comes to me and I'm selling the good. This is one type of sale. Second type of sale is the customer has requested me to arrange the transport from my place of production up to his godown. So it is my responsibility to arrange for the transportation of these goods until the godown of the customer. Third type of sale. I said I can't take the responsibility of the transportation. You come and pick up the goods. So I'm talking about two particular situations where I am taking the responsibility of delivering the goods up to the customer's place, or in the second case I said the customer will come to you, he will load his goods, he will only take the transportation. Let's say there was a loss during transit, or let's say there was an accident in the transit, entire goods have been washed away or burned due to fire. Now in such an accident, who will bear the risk? The loss has to be borne by someone. Now here comes the point. The first case, when the seller has taken a responsibility of transferring the goods or delivering the goods to the customer place, the customer will say, I did not receive the goods, so why will I bear the loss? If there's a loss in the transit, then who is bearing the loss? The seller should bear the loss because it was his responsibility to deliver it to the customer's place. Now, when we're talking about the second type of situation where the customer has come to the seller's location, have picked up the goods, he arranged for his transport and he left the godown. Now at that type of sale, I'll say, the seller will say, when you took the goods from me, the goods were in proper condition. If the goods are lost in transit, you arrange for the transit. So that means the responsibility or the risk and rewards have been in your hands when the goods are damaged. So who will bear the loss? Buyer will bear the loss, not the seller. Seller will say, I have no responsibility here. Here, to understand this concept, we'll talk about something called as performance obligation. Now, performance obligation is complete. Then you recognize revenue. Now, what is this performance obligation being complete? Performance obligation being complete means the risk and rewards on the goods should be transferred to the buyer. Then I will say the performance obligation is complete. Understand in simple sense, I would say that the performance obligation for a seller is complete when the risk and rewards of that particular goods are transferred to the buyer. Now, in the first case, risk and rewards are getting transferred to the buyer only when the goods reach the godown of the buyer. Because until the goods reach the godown of the buyer, the seller is taking the responsibility for such goods. So, any risk and rewards what are happening in the transit has to be borne by the seller itself. So, performance obligation is complete when the goods reach the buyer's godown. But in the second case, where the buyer is arranging for the transportation, the seller's performance obligation is complete when the goods have actually left the godown of the seller. So once the goods leave the seller's godown, the seller will say, my responsibility is over. My performance obligation is complete. The risk and rewards have been already transferred to the buyer. So whatever loss is there, that should be borne by the buyer itself. So when we are talking about sale of goods, the words being used are like this. Revenue can be recognized when risk and rewards incidental to ownership of goods are substantially transferred to the buyer. He's using the word risk and rewards incidental to the ownership of the goods are substantially transferred to the buyer. Not entirely, substantially. That means majority of risk and rewards are transferred. That is sufficient for you to record your revenue. Similar terminology of risk and rewards being transferred to the buyer has been taken in the concept of AS 19, that is leases, to explain a finance lease. In a finance lease also he uses the same terminology. He says that I'll call a lease as a finance lease if such lease transfers substantial risk and rewards incidental to the ownership of the leased asset, not the goods. Because here we are talking about sale of goods, there we are talking about lease of an asset. So substantial risk and rewards incidental to the ownership of the leased asset is transferred to the lessee. So if it is transferred to the lessee, then I'll call it as finance lease as per AS 19. The terminology which is used is very similar to what we see in AS 19. So if you want to refer, you can refer there. But as far as AS 9 is concerned, you can confine it to this. So risk and rewards incidental to the ownership of a leased asset should be substantially transferred. Should be transferred substantially to the buyer. Then I will say that the sale is complete. Now whenever we are discussing about substantial delivery, then what is a substantial delivery? Let's say we go to a car showroom and we want to buy the car. Now, as and when the payment is made, or you say that the loan has been processed, whatever it is, the entire formalities are complete. How is the car delivered to you? Sir, the car is yours. Now the fellow does not deliver the car, he gives the key of the car. Correct? So that is called as constructive delivery. So I would say substantial risk and rewards incidental to the ownership of the lease of the goods are transferred to the buyer there by giving that key. That key is giving an access to the car. Or let's say he has given you the key, the car is not there. So what happens? So I cannot recognize revenue because I am not transferring substantial risk and rewards. So got it? Use the word there. So whenever you are talking about constructive delivery, the good should be there along with the access to the good. Let's say I have a godown full of stock. How do you sell the godown full of stock? I can't lift the entire thing and put it in someone's hand, right? So what do? I give a key which gives the access to that godown. And I say this is your access to that godown. I've sold the godown to you. I'm not selling the godown, I'm selling the contents within the godown. So what is happening here? That is a constructive delivery. In the case of a constructive delivery, understand, unless and until the customer takes the possession of the good, I cannot call it as a revenue. Because the good might not be in a deliverable condition. Then I cannot complete the sale only. I cannot record it as a sale itself. So be very careful when you're deciding upon when is the risk and rewards being transferred to the buyer. Got it? Now, as we discuss about these three parts of revenue recognition, we'll also have to talk about uncertainty of collection. Uncertainty of collection in the sense, you sold goods or you provided service, whatever is the revenue, you don't know whether you will pay or not. Whether the person, the buyer will pay the amount or not. The customer might pay or might not pay. Now this is the problem, uncertainty in collection. There are 2 points at which the uncertainty might exist. Uncertainty existing at the time of sale itself. Uncertainty existing at the time of sale, uncertainty arising subsequent to sale. These are the two uncertainties that we have to discuss about. Uncertainty is existing at the time of sale. That means when you are selling the good itself, I don't know whether that fellow will pay or not. Then why did you sell? There could be hundreds of reasons. You can't come up with a question asking why did you sell? Because probably, let's take a peculiar case, a person in a nice 3-piece suit gets down from a 30-40 lakh worth car and is asking you, I have a big order in my hand, I want few samples. And you said, sir, samples also I will charge, I can't give free samples. He said, fine, you give me 10 units, if I like the samples, I'll come back with the 1 lakh units of demand. You thought, okay, sounds good. So you gave those 10 units to him. Now when you're giving the 10 units to him, he said, I'll come back again to give the order. At that point of time, I'll give you the cash. You said, fine. Because obviously there's a 1 lakh units at stake. So you don't mind giving those 10 units to him. But at the point of sale, there is uncertainty. Because you don't know that person, you have never seen that person. This is the first time that you're contracting with that person. So you do not have any trust on that particular person, but the way he has presented himself or whatever he has been presenting it to you in future, whatever he is promising to you in future actually sounds very attractive that you have made the sale. Or sometimes we normally may enter into contracts for the issue of prestige. Like a contract with a garment project, if some contractor is actually doing, it actually becomes a point of prestige. Even if the contract is not actually viable, still the contractor will do it just to get into the books as a garment contractor. So to get into such conditions, they even enter into contracts for loss also. You might not even recover the amount from the garment. Most uncertain thing is the garment. Now, this is existing at the time of sale itself. In such things, you cannot recognize revenue, so you'll say defer. Revenue recognition until such uncertainty exists. Defer revenue recognition until such uncertainty exists. So there is no certainty in collection at the point of sale, then do not recognize revenue. Then when will I recognize revenue? When that uncertainty in collection is getting eliminated, uncertainty is gone, then you recognize revenue. Arising subsequent to sale. At the time of sale, this person was all fine. But subsequent to sale, here becomes a problem. At the time of sale, the customer is a renowned customer. I've been contracting with him since long time, so I don't have uncertainty in collection. Normal credit period I have allowed. But during this period of credit, a major fire accident occurred in his factory. There could be a situation he might even file for insolvency as well. Now when you get to know about this concept, this is an uncertainty arising subsequent to sale. At the time of sale, everything was fine. But subsequently, there's an uncertainty which picked up. Whenever you have uncertainty which is arising subsequent to sale, in such situation, whatever revenue is already recognized at the point of sale, do not touch, but create a provision for the required amount. I'm expecting at least 40% of the amount will be recovered, so I'll maintain a provision for 60%. I'm not expecting 1 rupee also to be recovered, then I'll maintain the provision for the entire 100%. So create a provision to the amount of required or the amount uncertain to be collected. Now, there are plenty of peculiar contracts for sale or provision of services which we have to discuss. So, put on a heading, recognition of revenue, so one by one we'll be taking up a concept and we will be identifying what is the revenue recognition process for that. Recognition of revenue in the first contract that we'll have to consider. Installment sales. Very similar to hire purchase sale that we have. So the entire price of the good is paid in small installments. So right now we have a very genuine concept which comes up saying that buy a mobile phone and you can pay in 24 equal monthly installments, 0% interest. Well, there is an interest portion which is hidden, which is not actually disclosed to you. So what happens basically in such contracts, whenever you have an installment sale, we can break up the price as higher purchase price is equal to cash price plus interest. HP price is called as cash price plus interest. To the extent of the cash price, recognize revenue on sale. But to the extent of interest, we have just seen interest is always recorded on time basis. To the extent of cash price, recognize revenue on sale. To the extent of interest, recognize revenue on time basis. Delivery subjected to condition. Now what is this conditional delivery? Normally we take the case of an AC. We normally go to a shop, we have purchased an AC from the electronic store. Or when you buy this AC, basically what happens, the AC unit is sent to your house. But is the AC working as soon as the delivery is done? No, the AC has to be installed. It has to be mounted onto the wall or wherever it is, and then it has to be installed. Then only the process actually starts. So whenever you're talking about such delivery, I did receive the good. But what is the condition for the delivery? That he has to come home and install the good. Now unless and until that installation is done, the delivery has no purpose in it. So let's say the good is delivered, after 1 year he'll be come and if he fits in the good, what am I using it for last 1 year? So basically there's nothing. So what we are saying, there's a condition which is attached to the delivery. So whenever you have such situation, delivery cannot be recognized as revenue. On delivery, you cannot recognize the revenue. To recognize revenue, you need to fulfill this condition. You need to satisfy this condition and then recognize revenue. So recognize revenue only when condition are satisfied. Those conditions which are attached to sale should be satisfied for you to record a revenue. Guarantee or warranty sales. Now what is this guarantee sale or warranty sale? Now when we talk about a guarantee sale or warranty sale, normally we buy a good, comes with a 33 months warranty or 1 year warranty, 2 years warranty. Now what happens, warranty or guarantee? In the place of a guarantee, if there's a damage in the goods, he will replace the item. If it's a warranty, then he'll take a repair or he'll do the repair and he'll give it back to you. Now whatever situation we talk about, the seller is incurring an expense. To give you a warranty or a guarantee, if there's a damage in that particular good, the seller will compulsorily incur an expense. If there's a repair and a small part has to be replaced, so he has replaced that part. When he's replacing that part, don't you think the cost which is, whatever he is charging to you is free? But there's a cost which is incurred by the seller. The seller has to pay something and buy that particular part which is being replaced. So in the case of a guarantee or a warranty sale, seller has to incur some expense to satisfy the guarantee or to satisfy the warranty. Now in such sale, can I recognize revenue at the time of sale or should I recognize revenue when the guarantee is complete? Let's say I've given you 1 year guarantee. I sold the item today on, let's say a particular day, 15th of August I have sold the good. 15th August 2014 I have sold the good. Then when will I recognize revenue? Let's say it is a 1 year guarantee. Should I recognize revenue on 15th August 2015 or 15th August 2014 on the date of sale itself? Now this creates a problem. Whenever we are talking about a guarantee or warranty sale, we will recognize revenue at the time of sale itself. However, there is a future expenditure which could be incurred, correct? If you can reasonably measure that expense, that means, over the past management experience, he says that at least 15% of the goods or whatever which are sold have come back for some guarantee or warranty. And on an average, at least 2000 has been incurred per piece for such repair. So he'll use this estimate for creating a provision. He will say the total number of units sold during the year multiplied by the percentage, which is a normal rate of return which I get, multiplied by the cost incurred on the repair, should be used to create a provision. So at the time of sale, I will record the sale. At the same time, I'll also create a required provision as well. So both will be done. I'm recognizing a revenue, I'm recognizing a provision for the guarantee or warranty. So whenever you have a guarantee or warranty sale, recognize revenue on date of sale along with provision for repair or replacement based on management estimates. So management will give an estimate based on which you create a provision. So recognize revenue on date of sale along with a provision for repair or replacement. Whenever we talk about a provision, it is always an estimated amount, such estimate being given by the management. Famous concept that we know, consignment sale. What happens in the case of consignment? Consignor sends goods to the consignee. Consignee is selling the goods to the customer. So basically, the goods when they are sent to the consignee, I can't call it as a sale. Reason? Consignor consignee have a principal agent relationship. So even though the goods are moving from the consignor to the consignee is only holding the goods as an agent of the principal or as an agent of the consignor. I cannot recognize revenue on that transaction at all. Revenue will be recognized when the consignee sells the goods to the customer. Unless and until the consignee is selling the goods to the customer, I will still say that stock with consignee is also the stock, is actually the closing stock of consignor itself. And we use a word called as consignment stock. What is consignment stock? Consignment stock is consignor goods with the consignee. It is a closing stock for you. You cannot recognize revenue on such goods. So consignment sales, recognize revenue when consignee sells goods to customer. So some external customer should buy the good, then only you can recognize revenue. Just for selling the goods to the consignee, you cannot recognize revenue at all. Now very famous COD. What is COD concept? Cash on delivery. Very famous concept with Flipkarts, Amazons, Snapdeals coming up. A very popular sale is COD sales. Now when you talk about cash on delivery sales, most uncertain sale is cash on delivery sale, because basically people will book address of whatever they want. Shamshan Ghat also has become an address today for COD sales. So just because you have a time pass, you record whatever address you want and you can send the good there, because it's a COD sale and the delivery is free of cost. You don't have to pay anything unless and until you receive the good. So whatever sale you want, you can book. Or even if you give it to the current address, your actual address, as and when the good is received, you'll say, I'm really not interested, take the good and go back. This is also possible. I don't have cash in my pocket right now, you come later. Or you return of the good, I'm not really bothered about it. So whenever we are talking about a cash on delivery sale, this is the main problem. So in a COD sale, recognition of revenue cannot happen at the time of booking the order itself. So I have to wait for revenue recognition because again I'm bringing in the condition of uncertainty. At the time of sale it is an uncertainty. So when you will recognize sale? When the uncertainty is eliminated. So defer revenue recognition until the uncertainty exists. Now when is the uncertainty getting eliminated in the case of COD? When you receive cash. You receive cash, COD uncertainty is gone. So here COD, I will not recognize revenue when the book order is being booked, but you recognize revenue on receipt of cash. So when you receive cash, you recognize revenue in case of COD sales, cash on delivery sales. Delivery of goods delayed on buyer's request. Let's say 26th January was the delivery schedule. Seller is ready to deliver the goods on 26th January. Exactly at that time, the buyer has called up and he said, hold the delivery. Hold the delivery. I do not have sufficient space in my godown right now. I would ask for the delivery in some time. So as of now, don't deliver the goods. And the seller asked innocently, can I recognize revenue? The buyer said, yeah, you can recognize revenue. I have actually deemed accepted the goods itself now. So very good. The seller recorded revenue saying that sales account debit, the customer account debit to sale. He has recorded the revenue. Exactly as I put down the phone, someone else entered the godown. Someone was entering the godown and he saw the same goods. And he said, sir, I want these goods. He said, sorry sir, those goods are already sold out. And this new customer who walked in said, sir, if possible, I'll pay 20% extra. He said, sir, not possible. He said, 50% extra, I'll accept of. I'll definitely accept. When he comes to that extent, I'll say, okay sir, take the goods and go away. Again, he took the goods and went away and then again he recorded the sale. So new customer account debit to sale again. So I observe, one set of goods are only one manufactured. But how many revenues you recognize? 2 revenues you recognize. Can I recognize? There's no matching concept only. So basically what happens, you can recognize revenue when the delivery is delayed by his request. No one stops. But there are conditions which are attached for that. So let's see the conditions. Revenue can be recognized if, let's see the conditions. First condition, goods are distinctly identified. So I am identifying the goods in my godown separately, saying that these goods belong to that customer which I have already sold the goods. The delivery is only delayed on buyer's request. Point number 2. Goods are available for delivery on request of buyer. So subsequently when the buyer requests the goods, you can't say that you wait, I have already given the goods to someone else. I'll start production now. That is not possible. So the goods should be in a deliverable state when the buyer has requested for the delivery. The goods can be distinctly identified, and also we have come up to a situation where we said the goods should be in a state that they can be delivered on request by the buyer. Sale and repurchase. Now you will understand why he sold, why he repurchased. Let's say I talk about two people. I have Mr. A and Mr. B. A sold a particular good to B. Sale happened on 1st January 2016 at, let's say, about 150 rupees. On the date of sale to B, A has also entered into one more contract with B to say that B will sell the good back to A on, let's say, 31st December 2016 at the end of the financial year, but at that time they have to pay 180 rupees. Now this is called a sale and repurchase transaction. Now why did A and B enter into such transaction? If you understand, think from the goods perspective. As on 1st January, where is the good? The good was with A. On that day he delivered it to B. As on 1st January of next year, where is the good again? The good came back to A. So A is having the possession of the good ultimately. Then why did A even sell? Because when he sold, he got 150 rupees. He is using that 150 rupees throughout the year. At the end of the day, at the end of the year, on 31st December, I will repay back 180 rupees. That's it. So if you basically observe, it is a financing transaction. Such financing transaction security given is a good on sale. So I have given the good, I am taking 150 rupees. I will return back 180, I will get back the good. So don't you understand, this is a basic pawnbroking transaction. So it is a simple financing transaction. So this cannot be looked at as sale, and this is not one more sale. You can't look at a transaction like this. So we have to apply the concept of substance over form. So applying this concept of substance over form, I will say that this is not a sale at all. I will call this type of transactions as financial arrangement. It is only an arrangement for finance. It cannot be called as a sale transaction at all. So in this financial transaction, I will say that my interest is equal to, any financial agreement has an interest. What is the interest here? A received how much? 150. A repaid how much? 180. So what is the interest? 30 rupees is the extra payment interest. So this is nothing but repurchase price minus sale price. Repurchase price minus sale price is the interest. And again, when you come back to interest, interest should be recognized on what basis? Recognize revenue on time basis. Interest is recognized on time basis. Sale on approval or return. When do you recognize revenue for sale on approval or return? But this concept we already must have known now. So recognize revenue earlier of, what happens normally? I will sell the good, I'll give you 15 days period. During this 15 days period, either you can return the good or you can accept the good. Let's say 15 days over, I did not accept the good. What happens? At the end of 15th day, after on the 16th day, I cannot return the good. That means the seller will say that sale is already done. You did not return the good. I have given you a right to return the good during 15 days itself. So, a seller can recognize revenue earlier of 2 dates. Either on approval by the buyer. Buyer has called up or intimated the seller saying that I'm happy with the good. You can recognize revenue now. So either on approval or on expiry of time period allowed for return. So I have allowed a time period of 15 days or 20 days for the return. At the end of that 15 days or 20 days period, I can recognize the revenue because the right to return such goods has expired at the end of that 15th day or 20th day. So earlier of these two dates, you can recognize revenue. Subscription for publications. So what happens? Let's say I go for a yearly subscription of a magazine. A magazine yearly subscription I've paid. Now whenever we are talking about an yearly subscription paid, think from the publisher's perspective now. The publisher is receiving revenue at once. But there's a performance obligation from him. What is the performance obligation? To deliver the magazine to that person who has actually subscribed for his publication over the period of that publication. 6 months of subscription he has purchased. And what happens over 6 months period? Whatever number of volumes I'm giving for the particular magazine, I have to send it to him. Now, whenever you're talking about subscription or publication, obviously it is not possible for me to recognize revenue when the cash is received. Because what happens, the cash is received initially at the beginning itself. But that is giving rise to a performance obligation. So I need to wait for the performance obligation to be complete. But here also sometimes there is a case, I can actually take it on a straight line basis. Let's say monthly magazine. So I'll give 12 copies to that fellow. So 6 months over, 6 copies already delivered, 50% of the revenue can be recognized. But sometimes each publication cost might differ. Each publication cost might differ. For the month of February, Jan, Feb and March, I have a separate publication cost. April, May, June, I have another separate publication cost. Then I have again next 3 months a different publication cost. So when I'm deferring the revenue, then I have to take the proportion in which I'm pricing the good. So whenever we are talking about subscription or publication, if the price is uniform, so when the publication price is uniform, then recognize revenue on a straight line basis. If the publication price is uniform, you can recognize revenue on a straight line basis. So over 12 months if you have taken the subscription, I'll break it up into parts. But if the price is not uniform, then you can recognize revenue in the proportion of the price of magazine or price of publication. In the proportion of the price of the publication. Entrance fee for event. A.R. Rahman concert is there. Now, I started selling the entrance, I've started selling those, passes for the concert. Now, let's say 15 days earlier itself, I sold all the concert tickets. Exactly on that day, A.R. Rahman sir was not available, he did not come for the concert. What happens? The entire money, whatever I received, have to be refunded back to those people. So, I cannot, charge it as revenue. I can't recognize revenue as and when the ticket is sold. I have to recognize revenue when that event is conducted. So, entrance fee for an event can be recognized as revenue when the event is conducted. Another type of revenue recognition now, membership fees. Normally you find membership fee for clubs. So what happens, this membership fee, if it is taken periodically, it is fine. Periodically I can charge revenue. But if I take a life membership fee, then problem. A life membership fee, in the sense, basically I will take the entire cash at once, and that person who is taking that membership is entitled to enjoy the benefits over his life. How do I recognize revenue now? I've received the entire lump sum amount once, but my performance obligation is until that fellow is alive. So if that fellow is alive for the next 40 years, then my performance obligation is for the next 40 years. If he dies in 2 years, then my performance obligation is 2 years. So, how do I recognize revenue if I am talking about a life membership fee? Let's restrict ourselves to I'm talking about only a life membership fee. To a life membership fee, when we are talking about, I cannot recognize revenue so easily. So, he'll say, unique concept guys, but we have to accept this. He'll say recognize revenue over life expectancy of the member. It's sort of a unique concept guys, we don't normally do this. So basically if someone looks like about 20 or 25, then I'd say, then this person will be alive for the next 30 years or 40 years. Someone already at the age of 50 has come in, then I'll say 10 years, 15 years maximum. Someone came in at the age of 60 still looking healthy, 5 years. Someone who came in and was coughing on your face, then 2 years. So basically, life expectancy is difficult to measure. So basically, I don't recognize revenue like that. Normal, general accepted conditions other than the standard, what we do is we see this type of revenue recognition process when we are doing a particular chapter called as non-profit organizations. So because normally clubs which charge life membership fee are non-profit organization, and whenever there's a life membership fee, we'll directly add it to capital. We don't recognize revenue at all. We directly add it to the capital fund. We call it as capital fund and we add the life membership fee there without taking it as revenue at all. So, but still, what is there in AS9 I'm trying to discuss? Tuition fee. This also we have to discuss because tuition fee is normally paid at the beginning itself. So let's say I have taken a tuition for about 12 months. So I received a revenue. I have collected a revenue and for which I have to give them a tuition for about 12 months. Exactly after 9 months there is a balance sheet date. Now how do I recognize revenue? He'll say over the period of instruction you can recognize revenue. So that means 9 by 12 of revenue can be recognized on the balance sheet date. So whenever we are talking about revenue recognition for tuition fee, recognize revenue over the period of instruction. Last one, advertisement revenue. When do you recognize a revenue from an advertisement? Now, let's say there's an event like a cricket World Cup. Now, World Cup is not a single day event. We normally have about 2 months which is covered by the event. Let's say over 2 months they have sold an advertisement right. So I'm selling the advertisement right, and some customer has come up to me. Let's say ITC fellow has come up and he has subscribed for the advertisement right. Let's say I have sold him some advertisement right for a particular amount to the telecast that advertisement over the 2 months period. Now how will I recognize revenue? I am receiving the contract money at the beginning itself. How do I recognize revenue? Now in such cases he will say that at the time of advertisement, recognize revenue when the advertisement appears in front of public. Let's say I have subscribed to Times of India advertisement, one full sheet of advertisement for 1 year period. I said my advertisement should appear on every Saturday. Every Saturday this full page ad should come, and I paid single time fee for the entire 52 days. Sorry, 52 weeks or 53 weeks, whatever is there during the year. So, on every Saturday I am getting a full page ad. Nothing from Times of India perspective. He received the amount at once only from me. But will he recognize revenue? No. He will have to divide the revenue into 52 or 53 weeks, and each week when the advertisement is appearing in front of public, he will recognize revenue. So each week he'll start recognizing revenue when the advertisement appears in front of public. Got it? So this is a unique revenue recognition concepts for about plenty of contracts that we have seen. So with that we come to the end of AS 9.